Your money-making broadcast starts now. Good evening, Canada. Today is June 5th, Friday. Here are the top stories moving the markets. We are seeing a significant shift in sentiment as the broader markets officially enter a bear regime, triggering a flight to safety that is impacting both the TSX and Wall Street. From surging volatility to critical energy sector movements, we analyze how Canadian investors should protect their capital in this new environment. In this special briefing, we will dive deep into the Jarvis quantitative analysis to understand why this transition is structural rather than seasonal, and we will explore specific hedging strategies for the Canadian energy sector to mitigate the risks of a prolonged downturn. We will also examine the institutional flow data that suggests a massive rotation out of growth assets, providing you with a comprehensive roadmap to navigate this volatile period with precision and discipline. Before we dive into the big stories, let's look at the closing numbers. The S&P 500 closed at approximately 7,500, down 0.4% on the day and 2.5% over the last 5 sessions. The Nasdaq took a harder hit, closing at 26,000, down 1% today and a bruising 4.5% this week. The Dow Jones Industrial Average showed some resilience, ending slightly up 0.1% at 50,000, though it is still down 0.2% for the week. The Russell 2000, reflecting small-cap weakness, is down 3% over 5 days. Crucially, the VIX has surged to 21.51, marking 5 consecutive days of gains. This is a clear signal of rising anxiety. In other assets, the 10-year Treasury yield is at 4.47%, and gold has seen a sharp correction, falling 5% this week to $4,339.70. Bitcoin and other risk assets are feeling the squeeze as the market shifts toward a risk-off posture. This volatility is not merely a surface-level fluctuation, it represents a fundamental repricing of risk across all asset classes, where the correlation between equities and bonds is tightening, leaving few places for traditional diversification to hide. Big Story 1, the bear market awakening and the Canadian energy hedge. The most critical development today is the official transition of the market regime into a bear phase. According to Jarvis analysis, we are on day 1 of this bear regime, a rare state that historically occupies only 1.5% of the last 10 years. For Canadian investors, this means the typical momentum strategies are now dangerous. We are seeing the VIX, the fear gauge, surge for 5 consecutive days, climbing from 15.32 to 21.51, a staggering 40% increase. This structural expansion of fear is not a fluke, it is a signal. In this environment, the TSX often finds a sanctuary in energy and materials, but we must be cautious. While the broader S&P 500 is down 0.4% today and 2.5% over the week, the real story is the risk-off rotation. Jarvis notes that the current regime strategy should shift to RSI mean reversion, meaning we look for extreme oversold conditions rather than chasing trends. For those holding Canadian energy heavyweights, the focus must shift to cash flow and dividend sustainability. The Canadian dollar is reacting to this global instability, and with gold prices dropping 5% over the last 5 days to $4,339.70, the traditional safe havens are showing volatility. Jarvis warns that we are in a reflexive loop where rising volatility triggers more selling, which in turn fuels the bear narrative. The key for the TSX is whether energy can decouple from the tech-led carnage we are seeing in the Nasdaq, which plummeted 1% today and 4.5% this week. We are monitoring the 10-year Treasury yield at 4.47%, and any spike here could put further pressure on high-dividend Canadian stocks. To properly hedge, investors should look at the correlation between WTI crude and the TSX Energy Index, ensuring that their exposure is not overly concentrated in high-beta producers but rather in integrated companies with strong balance sheets. Big Story 2, the tech bloodbath and the institutional exit. Turning to the U.S. markets, which heavily influence our domestic sentiment, we are witnessing a coordinated retreat from big tech. The data is sobering. Amazon is down 9.1% over the last 5 days, Meta is down 6.2%, and Microsoft has slid 7.5%. Jarvis has identified dangerous technical patterns across the board, including double tops for Amazon and Meta, and a head and shoulders top for Microsoft. Most alarming is the volume on the QQQ, which spiked to 90 million shares compared to a 41 million average. This is a textbook sign of institutional distribution. When the big players exit, retail investors often get caught in the vacuum. For Canadians with heavy exposure to U.S. tech through ETFs or direct holdings, the risk metrics are flashing red. Meta, for instance, shows a value at risk at the 99% level of negative 7.96% and a negative Sharpe ratio of negative 0.37, meaning the risk-adjusted return is currently non-existent. Jarvis advises a Druckenmiller approach here: prioritize capital preservation. The goal is not to guess the bottom but to avoid catastrophic loss. We are seeing a clear divergence where only a few names like Apple are maintaining bullish SMA crosses, but the tide is going out for the sector. This tech rout is creating a ripple effect, increasing the cost of equity for growth-oriented companies across the TSX, particularly in the tech and biotech sectors in Vancouver and Toronto. The psychological impact of this rout cannot be understated. As the invincibility of big tech fades, we expect a broader reevaluation of all growth-oriented valuations, which may lead to a period of prolonged sideways movement or further declines until a new floor is established based on earnings rather than multiple expansion. Big Story 3, Macro Divergence and the Bank of Canada Outlook. Finally, let us look at the macroeconomic backdrop. There is a fascinating divergence between inflation data and market action. Expected inflation is sitting at 2.48%, down 7.8% over the year, and the Fed funds rate is at 3.63%. On paper, the cooling of inflation should be a catalyst for a rally. However, the market is ignoring the fundamentals and reacting to the volatility. This is where the PTJ rule comes in: listen to what the price is telling you, not what the data says. The price is telling us that fear is the primary driver right now. For the Bank of Canada, this creates a complex dilemma. If the US enters a prolonged bear market, the pressure to cut rates to stimulate growth will intensify, even if domestic inflation remains sticky. We are watching the Canadian dollar's stability against the USD as a proxy for risk appetite. Jarvis notes that the current portfolio strategy is heavily weighted in cash at 65%, which is a prudent move. In a bear market, cash is not just a lack of position, it is a strategic option to buy quality assets at a discount. The focus now shifts to the upcoming economic indicators next week. We need to see if the VIX can stabilize above 20, or if we are heading toward a true crisis regime, which historically has a much higher daily volatility of 5.019%. For the average Canadian investor, the move is to shift from growth to value and to ensure that dividend yields are backed by real earnings, not just accounting tricks. This shift requires a rigorous audit of portfolio holdings, stripping away speculative assets and replacing them with companies that possess pricing power and low debt-to-equity ratios, which are the only true defenses in a high-volatility regime. For Canadian investors specifically, the Bank of Canada faces a dilemma if the US downturn deepens. The TSX energy sector may offer relative safety, but cash flow analysis remains critical. The Jarvis portfolio maintains a 65% cash reserve, positioning Canadian investors to capitalize on beaten-down quality names when the VIX stabilizes. Key support levels to monitor next week include CRM at $180 and JP Morgan at $190. The shadow paper performance shows VA positive alpha and JP Morgan with 1.267%, suggesting these are quality names to watch for re-entry when volatility subsides. We must also consider the impact of the US dollar's strength. A rising USD typically puts pressure on emerging markets and commodity currencies, which could create a headwind for the TSX even if energy prices remain stable. Looking ahead to next week for Canadian markets, the key levels to watch include the Bank of Canada policy response to the US downturn, crude oil prices given the Iran Strait of Hormuz tensions, and the TSX energy sector resilience. The VIX direction on Sunday evening futures will set the tone for Monday open. Jarvis recommends maintaining the current 65% cash position and waiting for clear signals of VIX stabilization below 16 before deploying capital into beaten-down quality Canadian and US names. This patient approach is essential because the first bounce in a bear market is often a dead cat bounce that traps eager buyers. By waiting for the VIX to cool, we ensure that the trend has actually shifted from bearish to neutral or bullish before committing significant capital. To wrap up today's session, we are officially in a bear market regime. The surge in the VIX and the institutional exit from US tech are the primary drivers of current volatility. While the macro data on inflation looks positive, the price action is warning us to be defensive. Now, let's look at the Jarvis recommended lineup for this environment, focusing on different risk profiles. For a safe type play, the world's most legendary value investor, Benjamin Graham, would choose Fortis Incorporated, FTS, at $52.10. The rationale here is the absolute safety margin provided by regulated utilities. In a bear market, investors flock to predictable cash flows and essential services. Fortis provides a defensive moat that protects capital while paying a steady dividend, perfectly aligning with the need for capital preservation today. For a balanced type approach, the legendary Wall Street fund manager, Peter Lynch, would select Royal Bank of Canada, RY, at $135.40. This pick combines growth and value. RBC remains a dominant force in the Canadian economy with a strong balance sheet. He would appreciate the ability to grow dividends while maintaining a reasonable valuation relative to its book value, offering a hedge against the volatility seen in tech. For a growth-type strategy, the world's leading innovative fund manager, Cathie Wood, would opt for Shopify, Shop, at $102.15. Despite the broader tech rout, the long-term shift to e-commerce is an unstoppable innovation. She would view the current dip as an opportunity to accumulate a high-growth asset, at a more attractive entry point, focusing on the long-term disruption of retail rather than short-term VIX spikes. Finally, for a low-cost or contrarian play, the master of global investing, John Templeton, would choose Cameco Corporation, CCJ, at 44 Canadian dollars and 12 cents. He is known for buying when others are fearful. With the global shift toward nuclear energy as a carbon-neutral solution, uranium demand is a long-term structural play. This is a classic contrarian move, betting on a commodity that is currently undervalued relative to the future energy transition needs of the planet. Subscribe for daily Canadian market insights. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.